Welcome to this market intelligence briefing on the 2026 digital asset landscape, focusing on the scaling phase. We will examine regulatory frameworks, corporate adoption, and on-chain infrastructure. We see a significant shift where activity and liquidity are decoupling from volatile base layer metrics. This is migrating into regulated off-chain channels and yield-bearing on-chain collateral. Spot BTC ETF inflows have surpassed $21 billion, and corporate BTC holdings are at 1.1 million BTC. Pillar 1 establishes the new rulebook with the Genius Act and the Clarity Act. These acts replace regulation by enforcement with a predictable, rules-based operating environment. The Genius Act focuses on payment stablecoins, while the Clarity Act addresses digital commodities and jurisdictional clarity. The SEC Fast Track Schematic provides an expedited 75-day approval process for large-cap altcoin ETPs. This process bypasses the previous 270-day review cycles, provided the asset meets criteria like market surveillance, regulated futures exposure, and existing ETF exposure. The DTC tokenization workflow outlines the 4 steps: debit, mint, transfer, and reconcile. This SEC no-action letter provides a 3-year regulatory sandbox to bring U.S. capital markets completely on-chain, disintermediating legacy transfer processes. Pillar 2 is the TradFi/DeFi convergence, looking at 3 tokenization models. Model A is native issuance, offering maximum efficiency. Model B uses a special-purpose vehicle to bridge legacy plumbing, and Model C is synthetic/short sale, which involves significant counterparty risk. Real-world assets, or RWA, are becoming the new collateral base, with a $17 billion total value locked. On-chain finance is changing its backing, utilizing tokenized treasuries as collateral to tether DeFi to traditional financial yield. RWA officially surpasses decentralized exchanges in aggregate value. Pillar 3 focuses on the tech and yield engine through the L1 per liter 2 ecosystem matrix. Ethereum remains dominant in developer activity. Solana achieves high usage and protocol revenue, securing U.S. spot ETF approvals. Base is rapidly absorbing retail and institutional L2 liquidity. Layer 2 liquidity concentration shows aggressive centralization, with Base capturing 43.5% market share. Institutional liquidity and developer activity are centralizing around platforms that manage the user relationship and offer integrated fiat onboarding. Stablecoins are evolving into the global settlement rail, projected to reach $1.2 trillion by 2028. They are becoming default cross-border settlement rails and back-end fintech infrastructure. TradFi is actively defending its core deposit-taking business by moving it on-chain. The institutional flywheel is an industrialized, self-reinforcing loop of regulated capital and programmable settlement. It starts with regulatory clarity, driving institutional products, capital inflows, and infrastructure maturation. Finally, we examine the systemic risk blueprint. Risk 1 is price discovery fragmentation, due to degraded post-trade transparency. Risk 2 is MEV and execution frontrunning, where pending transactions allow maximal value extraction. Risk 3 is atomic settlement friction, potentially increasing volatility and short squeezes.